Good day, Market Chameleons. Everyone join us for the first time. Thanks for coming by and checking out the Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer. And let's welcome Dimitri Pargamonic to this stage. He's going to be talking about earning straddle historical performance. How you doing, D?
Good morning, Will. How are you?
Great. Let me bring up your computer.
Yep. Thank you.
Wow, that looks great.
Thank you. Good morning, everyone. And what we're going to cover today is an earning straddle performance. So I'm going to navigate and show you guys a example, and then we'll talk about it. So first, let's navigate to a symbol. We'll use Tesla in our example. If you notice, the homepage or landing page is different today. So the search up here, we're going to type in Tesla symbol and click enter. It'll take us to Tesla's main summary page. And over here on the left-hand side, let's go to earnings, interactive charts. And then I'm going to click on this menu up top to minimize it and expand our screen. And we have different metrics here that measure earnings, different returns around earnings for Tesla, for stock and options. So if we come down here, you see average option straddle return, negative 5.8%. So we're going to click on that. But what this does is takes the straddle right before the earnings announcement. So end of day before the earnings are announced, and then looks at the same straddle the next end of day after the earnings were announced. So it's end of day to end of day around that earnings announcement to see, well, did the straddle move up in price, which would be a positive return, or down in price, which would be a negative return following that earnings announcement. And this gives us a sense that it tend to be overpriced or underpriced, anticipating that earnings impact. Okay, so negative 5.8%. Let's click on that. And now this shows us all the data. And you could see here, this goes all the way back to 2014. And then we could, if we wanted to, we could narrow down this data, but let's look at the initial set. And here we have the summary stats. The average return was negative 5.8%. The best return was 164%. So that's up here. The worst was negative 72%, almost 73%. So if we're looking at a straddle premium, the most, if you're own it, the most it would go down is 100%, right? So we see that it lost as much as 73% the next day. The median return, so the median is if we split everything in half, from highs to lows, and half of the returns were above this amount, half were below, negative 21%. This here shows us the percentage of the straddles that increased in price, 38%, and 62% decreased in price. Okay, so when we look at this chart, this tells us the magnitude of the straddle change. So green represents a positive change. In other words, the straddle appreciated. A red represents a negative, or the straddle depreciated. But we put them all, next to each other, and this way we could kind of see the ones that were lower, the ones that were higher, and by how much. and this dotted line is the average of all of them. So if we wanted to narrow this down and see, well, this is going back to 2014, which is, 10 years. What if we just took a more narrow look to see, if this changes, with the most recent data? Because maybe, 10 years ago, or even 8 years ago or 7 years ago is not as relevant, that data, as, the most recent. Maybe we want to take that out to see, well, what if we just use 6 years of data? So we could click on here. If we could click on 6 years, now we see a different picture. So you could see all of a sudden, we had a returns of 50-50. So half the time it was up, half the time it was down. The average of all these returns was positive 7.4%. And you can see here, we had some big winners in the straddles. So some big moves after earnings. The worst was 71%, best was 164%, the median 7.3%. So you could see that, if we took a more narrow look at the data, now it's showing us that, here, we'll compare it to the all. Now it's showing us that the returns of those straddles are positive relative to longer term of a negative 5.8%. Okay, so you can see a bunch over here between 2014, 2016. We had a lot of negative returns. They tended to be overpriced. That kind of started to change over time. Okay, if we took a look at 4 year, then we had a positive 23% return, with 69% of those straddles positive. So you could see here that, as the more recent data has shown us a much different picture, where the markets tended to underprice the actual move. The next day, that straddle was higher than right before the earnings announcement. Okay, so if we wanted to look at it from a different perspective and just do it by quarter, we could just narrow down our data sets by quarter. For example, if the next quarter, let's say, is second quarter, and we want to just isolate those, we could just press Q2, and this will give us the data set based on second quarter earnings announcements. Okay, and here we could see that for the second quarter, this is going back to 2014, 58% were positive, 42% were negative, with an average return of 10.5%. This way gives you a way to compare a more narrow observations based on these parameters relative to the whole data set, okay, and how it changes, where maybe certain quarters tend to perform differently than the other quarters. How does the most recent history compare to a longer term history? And this gives traders, right, lots of insights on straddle performance, potential risks, potential rewards, and how the markets tended to price those straddles, those implied moves relative to the historical moves, to see where how much did it ever buy? If the markets were anticipated exactly the right move, then these straddles would be always perfectly priced and anticipate the move, but they don't. So this lets us see the magnitude of the errors of those anticipated moves versus actual. All right, well, so I'm going to stop there and throw it back to you.
All right, D, great job. People have been playing around with the new landing page, and they're very, very thankful and happy you've done it. It looks great, they're saying. So awesome job. We'll see. Any questions or problems, please email support@MarketChameleon.com. Another great webinar, D. Thanks for doing that, my friend. You have a great day.
Thanks, everyone. Stay safe out there. Have a great trading day, and we hope to see you tomorrow.
All right, D. We'll see you tomorrow. Thanks, buddy. All right, everyone. Thanks for joining another Market Chameleon webinar. If you're on any social media platform, please follow and like. If you are on YouTube, thumbs up are always appreciated. If you're joining us for the first time, please check out the Market Chameleon. Take a free trial. So go in the upper right-hand corner of Market Chameleon, click on free trial. Always nice to see new users and give it a try. And we try to put on a live webinar every day. So if you have questions, you can come on the webinar and ask them in the chat, or you can always email support@MarketChameleon.com. Again, thanks everyone for joining, and have a great trading day. If you're on YouTube, again, thumbs up, always appreciate it. Have a great day, everyone. We'll see you tomorrow. Bye-bye.